Um, so as always, I want to say thank you guys for joining tonight. Once again, this is open mic night, so to speak. So questions you may have, situations you may have, always willing to open it up to hear what's going on and how I can serve and help, and we can all kind of win together. Um, if there is nothing that anyone has from a standpoint, um, anecdotally speaking, I can always talk about a few things. Uh, I did also run through last week for the Thursday calls how to run illustrations specifically on the LERP designs or accumulation designs. So if you didn't have a chance to see it on the YouTube channel at Valor Financial under videos, this last one was mastering the art of illustrations. We talked a lot about running multi-carrier illustrations on term, which you can do on the back office portal. And then we also talked about running LERP designs or life insurance retirement plans using IUL strategies. So if you weren't there, feel free to watch the video. Have any questions, definitely feel free to give me a holler. Tomorrow, 4 o'clock Central, we're going to see the other side, which is going to be the death benefit focused IUL sales and how to strategically run those because a lot of people in the IUL market space, like I see things online and it makes me cringe. A lot of people will talk about IULs only as an accumulation based product when there are cost efficient, death benefit focused products out there for IULs. And some people just either don't educate or train on it, don't understand it, or think that because it has cash value, it has to be used, which is not entirely the case. So I would say tomorrow, 4 o'clock Central, if you have the ability, obviously the newsletter, it has, the links for registration. Definitely worth being on there for that. So, before I think of any canned presentation things, wanted to open it up to the floor to see if anybody had anything in particular that they wanted to talk about, focus on, running into situations in their local market. What's on anybody's mind if they feel willing to share, ask questions? It can be product, sales ideas, prospecting, whatever you want. This is really open forum for anyone to ask questions.
I'll ask a question. Um,
Yeah.
and I get the gist of it. Um,
Mhm.
but you just kind of sparked my thoughts. So when we're talking IUL for death benefit versus whole life, I
Mhm.
understand the difference in how the cash value is accumulated, but essentially the client will be doing the same thing with the cash value, which is what, letting it increase for death benefit, or help me out with that.
Yeah, so that's a good question. And really it varies between, I don't want to say whole life versus IUL because they are two different animals. But when you think about it, a lot of people will say whole life is bad because the cash value doesn't belong to you. I always hated hearing that phrase because in IULs on a death benefit product, or if it's not increasing, the cash value doesn't belong to you either. It's a point where people who can't sell whole life will try and stick it to people because they want to sell their product. They don't have both sides of the fence. We on this avenue have all sides of the fence. We have whole life, we have IUL, both types of IUL. So really what it does is when you think about how the design is set up, let me do this because uh, you know, I like I like drawing pretty pictures. No one's ever told me they hate this, so I'm just going to keep doing it until someone says it's illegible. So let me pull up a screen here. Screen one. Okay, everyone see the whiteboard okay?
Yep.
Yeah, we
All
see it.
right, cool. So when you think about it, when you talk about a traditional, let's say what's that? Okay. When you think about a traditional whole life plan, what you have is you have two pieces to it, okay? So the first piece that you're going to look at is, let's see, this is not either charging or working. All right, bail on that. So let's do this the old-fashioned way with the illustrations. Da, 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 da. So I'm going to go to WinFlex. And when we look at WinFlex, for example's sake, I'm just going to use Mass Mutual because it's probably the easiest to illustrate on the fly for me. But we have several carriers at our fingertips, but they're in WinFlex, so it makes it easier from a comparison standpoint. You'll see whole life 100 here, so you're basically paying for your entire life, is the idea behind this. And what you'll find is that let's say the issue age is 45. I'm not going to change anything. We'll keep it standard Alabama because everyone in Alabama is a standard on tobacco. Um, obviously joking to you. $1 million face amount. We'll go with options. There's nothing to change here. This is a base policy, so it's a traditional policy. Disbursements, none. Reports, we're not going to mess with those. I'm just going to hit calculate here real quick. Okay, so standard on tobacco, 45-year-old, $1 million face amount. Now, the premium for this is going to be probably around $22,000 a year, give or take.
Okay.
We'll see if I'm right. I like guessing, because when you do this for a long time, I don't know, it's just fun. Maybe 24,000, maybe it won't even run. Who knows? These whole life carriers sometimes. All right, cool. All right, 21,360. So I was right the first time. So when we look at this, there's going to be two sides of the column of the actual illustration, okay? Let me move these videos of people's faces, or just my face, really. You'll see the tabular values, and you'll see there's 21,360, and it's guaranteed $1 million, okay? The guaranteed death benefit column goes all the way out. You'll see you stop funding by age 100. The policy endows, meaning the cash value is guaranteed to have $1 million in it by the age of 100. That's what whole life does, is it endows at a specific time. But if you play your cards right at 100, you should have about 3.9 million in death benefit. Okay. So the idea behind how this really works is you have this non-guaranteed option that is your dividends. So they declare dividends on an annual basis, which right here is the dividend, cash value inside of the paid up additions, plus your guaranteed cash value, which you have none in the first year or second year. So then you'll see your death benefit increases because this dividend bought $10,000. So when you see this, think of like that chart, right? Where it's like, you have a 90-degree chart and you have a steady death benefit of $1 million, and your premium is supposed to eventually catch up to that $1 million to the endowment, the guaranteed cash value, all that stuff. Well, you have dividends that kind of increase over time. It's little pieces of insurance that are paid up. That's why they call it paid up additions, that are going to add on top of your death benefit. So, whole life is more costly. However, the benefits of what it gives you is an increasing death benefit without, asking for an increasing policy. So the part that I always hate is that when someone says, "Oh, well, the cash value doesn't belong to you," I could easily take this cash value of additions, which is 15,442, that's above the 41,240, and I could take that, and then this policy will drop back down to $1 million. So I can take the cash while I'm alive. It'll impact the policy, just like if you pulled it from an IUL policy, it impacts the death benefit. So it's exactly the same. But the idea is that when you look at death benefit focused IULs, you're really looking for a static face amount for the most part. You're not really looking for an increasing policy. Why? Because you try and keep costs down. So if I, for example's sake, took this same client and I flip it over to my tried and true favorite, the QOL Partners Group, with the Value Plus Protector, which is a protection-based product, everything's the same, 45 standard Alabama, solve for. I have to modify this. So I'm going to solve for premium and I'm going to have this go all the way out. I'm going to stop paying premium just like the whole life at 100. Index strategy, I like the S&P. Nothing for disbursements, no increasing. I'm going to hit calculate. So what you'll find here is you have $1 million on the whole life and it steadily increases over time. So once again, if the client lives to 100, the paid up additions do what they're supposed to do, you would have a correlation between the two and you'd have roughly $3.9 million in death benefit with an abundance of cash. The cash value by age 100 on this whole life contract is about 2.9 million or roughly, your $1 million plus your cash value. So once again, there is a part to it that makes sense. On the flip side, you'll see that the QOL product with the death benefit focus is roughly, uh, I don't want to say three times less, but close to 3 times less what the whole life is. However, there are trade-offs. For example's sake, the first trade-off would be the death benefit will not increase. You'll see $1 million here, million all the way through, and it keeps going. The other thing that when you look at these kind of death benefit focused types of plans, is the cash value is meant to help protect the $1 million death benefit. So, for example's sake, the projections when you run these illustrations is a combination between the premium and the rate of return that you're projecting to give you this $1 million death benefit. How much premium do you need for this to last all the way to 121? So if you'll notice here in the 0% column, the policy is not guaranteed all the way through. It is actually only guaranteed all the way to age 84, but that would also mean that you're having 0% for 39 years, which is statistically impossible. Even the Great Depression only lasted 3 years. And on top of that, you have to also have guaranteed charges right off the bat, which doesn't happen. So you have a lot of variables in the way here. But, again, when people are talking between the two products, these are both technically level products. But because you're paying 21,360, it's the assurance that you're going to have guaranteed cash growth. There's no down years in whole life. And on top of that, you're going to have the ability to, get dividends or paid up additions to grow your death benefit. So it is a lot more, though.
Got it.
Does that help?
Yeah. Yes. That's
Yeah.
absolutely.
So oftentimes, people will start out with a New York Life policy, a Mass Mutual policy, a whoever policy, and then maybe the objectives change. Maybe they want to stop paying premium. Maybe they want to, reduce their premium durations and things like that. Now, argumentatively speaking, if I went back to this whole life illustration for a second, the biggest hindrance I have when people talk about whole life is they talk about whole life to the extent that, oh, I'm going to tell you you have to pay 21,360 only for 10 years, and then you can stop paying premiums. And when I hear people say that, it makes me cringe because the dividend hasn't matured enough where it'll cover the 21,360. Matter of fact, it's only at 75.05.
Mm-hmm.
Okay, so what happens is you have this cash value that's built up from paid up additions that what it'll do is it'll supplement until this dividend reaches this premium. So you'll see this roller coaster effect on the policy, and if the dividends don't stay strong or grow, then this $1 million will suddenly start dipping into the guaranteed cash, and then you'll have loans and other things that'll impact the policy. So when you look at how whole life is designed, it's roughly around 20 years where the dividend should be able to catch up to the premium and pay for it. But too many agents are trying to get a sale with a big ticket number, so they'll either keep the premium high and tell them they should only pay for 10 years, or they'll integrate term into this to reduce the cost of the product. But there's pros and cons to that too. So if I were to competitively say, like, hey, maybe the client wants to keep $1 million, well, you know, 81, 82 is obviously a lot more cost efficient, pending on how much risk the client wants to take. But if we were to really compare apples to apples, if I were to take this and flip the script and do a solve for face amount with, for example's sake, let's just say $20,000, and then I hit calculate, it's a question of do you want money now or money later? So the crossover point, this will probably be for a 45-year-old standard. I want to say like three, maybe 4 or 5 million. Um, so let's see if I'm right. It'll probably be, well, it could be, gonna sound like a weatherman, 2.5 to 5, somewhere in that range. I want to say 4 million, but I've been goosed in the past by some of these. Yeah, see, 2.5. So, and it really proves my point. So let's look at the whole life. You're paying 21,360, paying about the same here. Again, I'm not squabbling over $1,000 per year, though it could mean a lot. What does it take, or how long does it take to get to the crossover point of the IUL? It's usually about age 84 or 85. So 2.47, 2.43, 2.5. So the question I always tell people, especially if, like, say they are now in their 60s, they have, roughly, let's just say 538,000 in cash, and we 1035 that over with the same premium, you're probably going to get 2.5. The question is always, do you want 1.4 now with the hopes that at 84 or 85 you'll get to that crossover point? Or would you rather have 2.4 now that if you died anywhere in between 84, between 65 and 85, you actually have a better death benefit to pass on a legacy with the death benefit focused IULs? It's a toss up. Some people will stay tried and true to the whole life, and again, it's okay. Some people will say, well, I'd rather take the risk on the IUL because, markets tend to do better than, what we're showing at a 6.32 rate of return. So let's roll the dice and see what we could do. So it's just a toss up. But that's honestly some comparisons, that people have between whole life versus IUL. Once again, this can be reduced by adding term inside of the mix, and that would also keep you around $1 million in face amounts. So those are some ways that whole life will combat the cost efficiencies of the IUL. But when you do that, now you're adding in term, which the term is supposed to be overtaken with paid up additions to turn into permanent. But if the dividends go down, then you're going to run into an issue there too. So um, I know some of that might be Greek to you guys, but hopefully most of that made sense. I think the big thing to also say is that when you look at these and you want to kind of analyze it, so if you're doing policy reviews for clients, they have something. I got my first one today, so someone used this quotes.valorfs.com. So if you want to send in I need to change this to enforce, not enforce, but enforce policy review, you can put in all the details of what you have. You can even upload at the bottom a statement. It'll come into my email, and then I will start working on it to see what options are available. So it's right here, but it's not right on the main page, which again I'll fix. But um, so we have these available. You don't have to know it all, like I was talking about with these comparisons. But if you're doing policy reviews from other companies that your client already has, feel free to go to quotes.valorfs.com and let me do all the hard work for you, from that standpoint of case design. I don't have access to Valor FS. Should I ask again? You don't need access to Valor right now. This is actually an open site, so quotes.valorfs.com. So what you'll see here, and this will kind of go into stuff that I'm working on. So when you go into the advisor login and you connect, basically when I log in, it's not a working site yet. Okay. So this is just a placeholder right now for our back office to get us to places like WinFlex, iPipeline. I am putting in I should have iPipeline integrated, probably by the start of the new year. I'm working on, kind of getting a few bids together to put together the back office. I have a pipeline set up, so there's going to be more of this stuff available. So we'll have it all in one spot. Sure, I'll see and stuff like that too. What you'll see in the future is, a growing opportunity from this standpoint to have it all clean, concise, and in one spot. But Armando, you're not missing anything from this right now. What I would just say is if you have quotes, feel free to put them here. I'm trying to create some quicker links to make it easier from a streamlined approach. So as of right now, I have this quote request form, quotes.valorfs.com. You'll see a theme here in a second. So income focused, death benefit versus accumulation. Is accumulation based? What type of products do you want to see? Current retirement, if they have any, if you know any of that, or any relevant information you can attach. Term, long-term care, disability, DB focused IULs or whole life, annuity quoting. So we have it all right here. That's one quick link, appointments.valorfs.com. Once again, like I said, you'll see a trend. So people who want to book time with me, 30 minutes, 60 minutes, calls or Zooms. And then, as you get started with us, we do a contracting.valorfs.com as well. So this will give you contracting for our different avenues and things like that. So again, the idea is to simplify the process. The one thing that I will also mention is that I am working on God, I have way too many things here. Let's see if this is right. So I think this is it. That's it. So starting a Go Collab page, this will be integrated also into the back office. This will also have learning modules. So we're going to start having modules on getting started with Valor, which will have some training courses in it. And then we're going to continue that from the standpoint of having, 101 basics, other things, how to run illustrations all in one spot. So there's a lot of technology stuff going on in the background for what we're doing with Valor to ultimately streamline the process, make it easier for you guys to get in and get going. And for those who are building organizational structures and you want some type of management system, we'll have that for you too. So the idea is how can we simplify this and take all these, YouTube things and kind of streamline it into one spot. So there's a lot to a big undertaking, to say the least. But yeah, to kind of go back, Armando, to your question, you don't need the Valor, back office information yet. So we'll try and work on single sign-on. We'll try and work on some of the other stuff before we start unleashing it to the public. I'll put it that way. So more to come. So, other questions? Anyone have any other questions or comments, things that you might want to talk about tonight before I go off on another tangent?
What's hot for long-term care these days?
That's a great question. So what I'll say first is that if you haven't had a chance to watch the videos that I did, I want to say earlier this year, I don't even remember at this point. Not retirement training. Right here. Okay, so there's a few different trainings that I did on this. You'll see ABR training. So your basic ABR training, living benefits. Um, Agent training on traditional long-term care, hybrid long-term care life products, and then also insurance products with long-term care chronic illness riders. So what you'll find is, kind of going back into WinFlex, the hot to trot products are the hybrid products because it settles a need quickly and then people move on. So financial advisors use them a lot because it gives you liquidity in case your client wants to cash in the policy, a big bucket of long-term care, and a marginal death benefit with very little underwriting. I'll put it that way. So the initial big brand to first start these hybrid products was actually Lincoln with their MoneyGuard products. So they've enhanced their MoneyGuard products. However, in the grand scheme of things, there's other carriers that are offering better solutions. So One America is a great product. They have an unlimited benefit. It's on a whole life chassis. Other ones that work very well, I like Securian. I think they offer the best benefit for single life, and then you have Nationwide for joint life. But if I were to show you, for example's sake, Securian here, from a long-term care perspective, what we would be looking at is the Secure Care, believe it's three. Let's see if I'm right. All right. Yep. So I'm right here. So we'll do Tennessee for this time. We'll do 65. And we'll actually I'm going to show you a male and a female so you can see the difference. But solve for, let's say the client has a single premium and they want about 100,000 in. You can do 5, 7, 10, or 15 with this company. Other companies you can do 5, 10, 15, 20. So different carriers have different benefit durations. But initially, what this value proposition was a single premium to get it done with. Again, financial advisors want to put the least amount into insurance so they can put the most into assets under management. That's the old school way of doing it. So this filled the need for long-term care for a very small amount, comparatively speaking, versus a premium consistently coming out for long-term care. Had death benefit, liquidity. I'll just show you as opposed to me constantly talking about it. And it fills the need for long-term care. So the rest of the assets can stay, performing in the market so they can get their returns. So, The agent can get their fees.
I, I concur. It's the path of least resistance for financial advisors for these
Pretty
products.
much. It really is. Cause I mean, and it's funny because Roderick won. Roderick's made a great point about this, and I kind of laugh. Financial advisors don't care about what's going on in your health. Your doctor doesn't care what's going on with your finances. We have to look at both. In ours, we have the most intimate products to sell to anybody. We care about your finances, we care about your health, we care about your social, date of birth, your beneficiaries, what's their socials. So, yes, it's a very intimate product suite from that standpoint. But so here again, path of least resistance. Let's put $100,000 into the Securian product for a 65-year-old male. It gives you a bucket of long-term care of $483,000 or monthly $6,718. Okay. So same thing. We didn't do increasing or compounding. We just kept it simple right off the bat. You can add compounding to this, but really, again, when it boils down to it, what people like doing is seeing the numbers. And you'll notice here the surrender value, you're instantly liquid up to 85%, and it grows over time. And even by year eight, you're actually making money on this, but your death benefit stays the same. Let's see if it stays the same even all the way out. Yeah, it stays the same even all the way out. And your LTC benefit in this scenario stays the same. So 6,719 is your total dollar amount monthly. So there is a cap on how much you can get annually, or your total monthly in this type of plan. But it looks nice because it's a huge bucket. I'm giving you $4.8 of leverage to every dollar you give me. So it's a great story. Now let's look at female, exactly the same parameters, not doing anything different. So the question would be, uh, will a female get more LTC coverage, less, the same? Let's see. Does anyone know or want to take a guess before it hits done? Ah, shoot.
I'm gonna say less.
I'm
Why?
gonna say more.
You say more, less,
Yeah, it's gonna be less.
less?
Less
Okay.
premium.
Less. So we've got a lot of lesses and one more. Anyone else want to take more as a gamble?
I'll take the over.
Let's take the over. All right. Well, let's see. Drum roll, please. 145. And let's see what the benefit is here. 436 versus 463, was it with the or 480? 480 something? Um, let's see. Let me go back. Yeah, 483. So, those who said less, who's bold enough to say why women are less?
Women, what they live longer and cost more to care for. I think that's what it is.
Yeah, as I say, you're right. Ross, I saw you come off mute. I'm always intrigued to hear what you have to say.
Well, I just always think back to a joke my father always told me, but we can talk about that offline.
Okay. Oh,
Women
the
cost
answer,
more.
I was gonna say, in both in
Women
life
cost
and death.
more.
Yeah. No, the answer really is that life expectancy is longer for women and they hold on longer. So, average male goes into a nursing home. If you don't count mortalities in the first year, we last about 18 months in a nursing home. If you add the mortalities in the first year, it's 9 months. Women go for about 3 to 5 years. So stubborn all the way through, all the way. So you can't get as much benefit because the simple fact is you're going to use more of it than the males are, plain and simple. So there's always a gimme and a gotcha. For once, we actually have a better benefit in this space. You guys have cheaper car insurance for ladies, cheaper cost of insurance for life insurance. Here we actually win. Unfortunately, it's because we die quicker. So trade-offs, right? Now, if for example's sake, this is your hybrid policies. So once again, the idea here, liquidity, less liquidity for the ladies too. Death benefit is roughly about a 50% increase of what you put in. And your bucket of long-term care is about $4.3 for every dollar you give me. So it's a good story, like I said, but if someone were to take it and flip the script, so for example's sake, in these scenarios, your monthly is a little bit over 6 grand for $100,000 premium payment. Now, if I were to change the script, use my tried and trusty true Value Plus Protector with my 65-year-old female, standard non-tobacco, Tennessee resident, we're going to solve for a face amount of no premium. We'll leave it to 121. Let's make it harder for me. Level annual pay, we're going to do a one-time payment, external lump sum of 100,000, and I'm going to do it one time. And I'm going to add the AAS rider, which is 2% of the death benefit per month until it's completely liquidated. We're going to see what we get from the standpoint of the 65-year-old female, comparatively speaking. So once again, your total bucket is 436,000. Total death benefits 145 on $100,000 single pay. This will be a mech for this policy, but it doesn't really matter. What we care more about is death benefit and long-term care or chronic illness benefit because they're going to fall in the same parameters as this long-term care piece. So what you get right off the bat, 266, 392. Okay. So 266, 392. You have, comparatively speaking, first and foremost, you have a higher death benefit by over $100,000. So your client has 266, 392. Ironically, the surrender cash value is about the same as what you had with that other policy. Okay. So right off the bat, you have very similar cash surrender values. This policy actually starts to go above the 100,000. I think the other one took a lot longer, if at all. You have a return of premium here, 50% in year 20. And then year 25, it didn't hit the amount to give you the full ROP just in case. But let's look down at the AAS rider. All the way down. I think I'm getting close. Cemex signature. I missed it.
Hey, Phil, real quick, if I can jump in, that return a premium rider there, I think that's powerful because it's not a premium paying rider. It's built right into the fabric of the policy, which I
Yeah.
think strong because other carriers you have to pay for that ROP.
Yeah, it's definitely added a lot of teeth to this product. I personally, that's the reason why I converted my term to that versus the max accumulator, is because at the time of my 25 years, I'll be 67-ish. And if I need it, then I have all the money I put into the policy back if it hasn't made more. But the living benefits, more than likely, I'll keep it. But yeah, it's an extremely impactful piece to this. I can't believe I missed. Well, I don't even know why I'm doing this. Um, so 266, yeah, right there. 266, 391. Times that by 2%. 266,391 times by 2% is about 53.27 a month. So I guess the question would be, which wins? Securian or the max accumulator? Remember, you're getting about 6 grand with the Securian product. You're getting 5,300 with this one. So which one would you pick?
But Phil, will both the products cover the same exact issues, like, from eligibility standpoint to receive this?
Yep. Can't perform 2 out of 6 ADLs, the whole 9 yards. So the Corebridge was the first company to actually switch from only permanent on their chronic illness definition to temporary and permanent. Prudential followed suit, so they do the same. Um, Nationwide has a indemnity-based long-term care rider, so that kind of tips the hat a little bit on what I'm trying to allude to. Um, when you look at this is going to give you a higher death benefit than what the Securian product would give you. Okay, so I would say there's a tick mark for the death benefit. The Securian product is a true reimbursement product, so it's receipt based. So if you don't use the full 6,000 per month, you don't get the full 6,000. This is indemnity, so you get the full 5,300 cash in hand. You can use it for unqualified or unskilled nursing care. You can use it however you want. So, truthfully, it really depends. Beauty is in the eye of the beholder. What does the client care more about? What are the values that come to the table for them that make more sense? The downside is most of the time when you do the hybrid products is kind of like what Juan mentioned before, path of least resistance. It's usually like a tele interview, maybe lab work, but a lot of times it's either tele interview or online interview, and that's typically it. Whereas this, more than likely a 65-year-old, well, 65 years old or 59, so they would have full underwriting. So you'd have to go through the process of full underwriting.
Does the Securian product come with a care concierge or care coordinator benefits?
I believe it does because when you talk about traditional LTC policies, they usually give you coordination. I haven't seen anyone who hasn't at this point, but um, securing long-term care, education based on state. I'd have to look it up, but I'm pretty sure they do have it because it's become almost a status quo or a requirement. Hancock has it for their long-term care rider, so they have the concierge help for specific needs. So, so yeah, I would say yes. Uh, in this situation, but I don't know offhand.
Okay. So
Yeah.
basically, based on what you said, the way what I took in is like, all right, if you want um your money to be of a more utility, more flexible, um, I like the IUL with the either the free rider or the
Yep.
AAS rider, because with the AAS rider you can control more or less how much you get, just like you can with the Securian product.
Yep.
However, if you wanted just more just straightforward um, long-term care protection with having access to the care coordinator, which I think is definitely worth it, right? So all you have to do is just worry about getting your care. Um, then the Securian product is the better option for that one. Then.
Well, Corbridge has care coordination too.
Awesome.
Yeah. So, they have a I forget what the company's called, but it's like so generic, it's hilarious. Um, I forget the name, but it was just really ironic when I would always talk about it. Um, like it's like Care Coordination LLC or something. It's like something very generic. but they have it too. So they'll help you find the most cost-efficient nursing home, in-home care, whatever you need, they have that as well. So it's
Right.
like I said, it's become pretty much a status quo. So that, a lot of the lines are blurred between how these work. And so, Jaya, to answer your question, I'll answer it with a political answer. It depends on the client, it depends on their perspective. Because, if it were me, it'd be like, well, my fat keister's probably gonna need the full 6 grand every single month. So I'd rather take the Securian. But, it's a trade-off on death benefit. But like I feel this is just a philosophy of mine, where when you think about it, you like that, Ross? When you think about it, men tend to die quicker than using the benefit. So if I were talking about myself and my wife, I would probably get my wife the Securian for longevity purposes, and me the Corbridge with the AAS rider because the death benefit will roll over to my wife and she can use that to supplement on top of the Securian product. So it
Got it.
mixes
Got
and
it.
matches.
Mm,
Yeah. So
Helpful. Thank you.
All right.
Thank you.
And
right.
then if for some reason the client doesn't want to go through full underwriting, you can then always pivot to the easier,
Exactly.
easier
Your
one to
path
get
of
done.
least resistance. Yep. Yep. And so that's why I say in certain scenarios, like 19 years of doing this, no client has ever been the same. Everyone has different feelings, emotions, stuff like that. And so you really tend to kind of, it always goes back to the same thing that I always say is if you don't ask the questions, you're not going to get the right opportunities. So, and when you ask the questions, what'll happen is it's a dance. So you lead with your questions, they answer them, and then you're at a different pivot point. So if I said, well, Ross, for example's sake, I'll pick on you. Ross, if you were looking at long-term care, does death benefit matter to you, or do you care about the most long-term care benefit? Well, you know, which one would it be?
I'd be looking for the long-term care benefit.
So, are you looking for something that is a quick and simple process? Do you care about underwriting, peeing in a cup, drawing blood? What's easier for you, or what do you care about? Does it matter?
I'm a quick and simple kind of guy.
I know you are. Um, and so, are you willing to fork over 100,000 now?
I
So,
don't know. I was hoping to get more business for my upline.
I know. I'll talk to that cheap son of a gun.
I'll talk to
So,
Garcia over there.
yeah, Garcia, the tie and everything, such a formal guy. So, but yeah, no, that's really it. It boils down to asking the right questions. Once you ask the right questions, it starts to lead to, just a better way to solve the problems. So with the care coordination, yes, there is care coordination with the quality of life product. Yes, I am a financial professional. So if you go to the living benefits tab in the QOL section, living benefit details. Let's see if it's in here. Yeah, AAS LTC coordination services. So yeah, they have care coordination program. What kind of assistance is available? Yeah, the company's LTCG. That was a long-term care group. So
Mm,
very, very convenient name. Locate caregiving, develop a plan, direct to organizations, set up first home care visit. So yeah, it's complementary or it's built into the AAS rider, not the living benefits, but the AAS specifically. So I'm pretty sure Securian has it too. There's so many different micro sites that these people give you. It just gets a little overwhelming. So I'm not even gonna try because it's gonna ask for some type of
Well,
password.
well, if they both have the care coordinator, then I see then the security end just really shines. It just provides greater leverage up front. So if you care about that more, then
Exactly.
yeah.
So simplicity and getting it done. quick and dirty, especially if your client's healthy. Obviously, if they have some ailments, quick and dirty is never the best way to go. Um, a lot of times, I recall from Lincoln, their money guard, the knockout questions, they usually have only like 10 questions, and it's like a 50% pass through because the knockouts will just completely decline them. So it's hard to pivot that somewhere else because it's just knockout questions. So sometimes full underwriting might make more sense. So what I would say is we're almost at the top of the hour. Any other questions, that you want to kind of go over? I know, we had a pretty wide array of conversation, death benefit focused products, long-term care and long-term care type solutions. Long-term care solutions and death benefit focused products usually go hand in hand. They're probably one of the best things to happen to um, life insurance is adding these type of products to them. Because statistics are daunting. You're going to have probably about an 80% chance of having one chronic illness issue. I think it was like 65%, somewhere in that range, to have two in your lifetime. So this has definitely helped boost the insurance business. I personally like doing more death benefit focused sales than I do accumulation sales. Why? Because it goes back to the main fundamental reasons why you sell insurance, death benefit, but also you add in these things like long-term care, it solves another need. I went through a personal experience watching my mom take care of my grandmother, and it became more of a employer-employee versus mother and daughter kind of situation. So this side of the house, death benefit focused products mean a lot more to me than accumulation products, a lot less maintenance too. Um, so from that standpoint, I still like to find the true need as to why people buy life insurance versus just talking about cash value all the time.
Oh, I thought you were going to say you like protection cells because bigger death benefits equals more money.
Well, I mean, you actually make more on accumulation products. So if I did a million DB with a Max Accum and a million DB on the Value Plus, you make more on the Max Accum, but there's higher cost to the customer because it's meant to be an accumulation product, increasing over time versus level, but they're available. So but yes, I do like doing estate planning cases. Bigger cases equal bigger opportunity. That as well is always something that I would say whets the appetite a little bit more too. So I've told several people this, and I'll say it till I'm blue in the face. I'd rather work on 4 6-figure cases a year than working on 40, 4-figure cases. So it's just not my cup of tea. Again, I'll help anybody with any case, don't get me wrong. But if I were going from the personal production route, I would try to be elephant hunting a lot. So that's just a personal opinion. Um, but yeah, so a last question. Question? Going
Uh,
once, going
I have a
twice.
question not related to LTC but related to
Yeah.
annuity. Are there
Yeah, what's
any
up?
annuity companies or the products? Let's say you put in 100,000 and then it accumulates some interest, right, based on S&P, for example. So
Yep.
only based on the interest what you receive in a particular year will there be distribution based on that. So based, I mean, to my knowledge, you can get a fixed income where you get a fixed amount of dollars every month, or some point of time you just do not take distributions based on how it's grown they might give you, but rather,
Mhm.
let's say someone wants to put 100,000 today and start collecting the income, say, immediately, and their goal is, hey, I don't want to use my base 100,000, rather how much ever the income that I could get, I would like to get that as income. Is that possible?
Yeah, so that would be a MIGA, a multi-year guaranteed annuity. the MIGAs will allow you the opportunity to pull on the anniversary, not right away, but the interest gain for the year. So if you had a MIGA that did 5%, then you could pull out the 5%, after the first year because that's the interest. So you'd retain your principal and you'd keep and they'd be able to pull out the interest gained, which they'd have to pay taxes on. The downside to that, from a sheer greed standpoint, MIGAs pay crap, like you're talking like 1 or 2%. It's nothing to write home about, but if that's what's meant for the client, that's what's meant for the client. If you're trying to do something from the S&P, you can pull out up to 10% usually from year over year. Some carriers are interest only, but most of them give you a 10% free withdrawal based on the duration that you have for the annuity set up. But if you're looking for a fix and consistent, then you would do a MIGA. If you're looking for something like you mentioned with the S&P, there is volatility to it, i.e., you're not guaranteed the same interest every single year. But yeah, you should be able to, more than likely, it's going to be around that 10% number or less anyway. So you could do it that way.
Okay. Yeah. Thank you.
No problem. All right, guys, 9 o'clock. Appreciate it. Tomorrow, again, we'll talk about how to run death benefit focused solutions. We'll have this video uploaded to the YouTube channel. So that way you guys have that available, for any people who need some nighttime sleeping material. But other than that, as always, I appreciate you guys coming on. We'll do it again, same time next week. Actually, should be same time next week, pending. So I have a trip that I'm going to be taking a tour of Texas, and I was hesitant to kind of say it because it's not like I'm going to be there for a long period of time. It's literally like Tuesday, Houston, Wednesday, Houston, Dallas for one day, and it's part of the sports agency side. So I'll be with Roderick. We'll be doing some stuff for that. So I'm going to keep next Wednesday as tentative. We should be on track to do it. But just in case, you'll know why. So I'll keep you guys posted. But Thursday should be a go. And this Thursday is obviously a go. So love to see you guys tomorrow.
All
And
right.
if
Thank you,
you,
Phil.
oh, no
Hey,
problem. You guys
Phil,
have
quick
a great
question.
night. Oh yeah, what's up?
Does Symetra have a term writer on their IUL?
Yes, the Ascent
They
product
do?
does.
Yes.
Yeah.
Okay.
Yep. Yep.
Thanks.
So no problem. All right,
Thanks.
guys.
Good session.
Have a great night. And we'll see you next time.
Yes, sir. Peace.
Bye.